I heard about this thing that's called 1% for the world, which is basically, I'm pretty sure it's called a very similar phrase to that, which is basically this idea that if every corporation just took 1% of their sales, their net revenue, their top line sales, and gave it to good causes, that we could basically solve the world's problems. And I was like, that sounds great. I'm like, 1% sounds small, so I decided to do 2%. And so for the entirety of my company from that day forward, we just took 2% of our sales and actually split it equally among our employees and let all 7 of us choose whatever charity they wanted. I think people just assume that's also true. And so when people get into the investing world, they say, okay, how do I make this more complex? They're finally like, I've been avoiding this for 20 years. I gotta learn, show me derivatives, options, futures trading, because that must be the best, because that seems super complicated. But it's not. It literally makes less money. And the reason behind it is just the nature of the efficient market. The stock market's very efficient. The market's efficient because so many people are participating in the market. Trying to fight them for your piece of the pie is just kind of like a losing proposition. They say the more your portfolio, your investments are like a bar of soap. The more you touch it, the smaller it gets. The optimal way to invest is to put your money in, minimize your fees. Don't be paying high fees to actively manage mutual funds or financial advisors or anything that's going to slowly erode your gains, and then just leave it. Our recently departed Charlie Munger said the money's not made in the buying or the selling, it's in the holding.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Becky, and I'm also a late starter, and we're your hosts. We're here to help you with your journey to financial independence, no matter where you're starting from.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. I'm here today with my co-host, Becky, and a real special guest. Becky, how are you doing today?
I'm doing great. I'm all bundled up. It's 9 degrees here right now.
Oh, that's coming our way too. That's definitely coming our way too. I just got back from the hospital where I took my Labradoodles, as we do most Fridays, to visit with the kids with cancer on chemotherapy and in the hospital, as well as the staff. And it's a joy in our life. It's one of those give backs that doesn't cost anything. And we deliver lots of love and smiles, and all these kids that are unhappy in their rooms, stuck in the hospital, just brighten up as soon as the dogs jump up in the bed with them.
Oh, I bet they do.
What you been up to?
Well, I am in a couple of days, I'm going to start packing for my FinTalks cruise. Stephen and I are meeting up with 65 of our closest 5 friends for a little cruise out of Galveston, which probably will have already happened by the time this airs. But at the end of January, we're going on a cruise. So I can't wait, especially since it's 9 degrees here. We're going to go see some sun.
Amberly Grant's been running this thing for a couple of years now, and it's a relatively low-cost membership. And I would encourage any of our listeners to search FinTalks or Amberly Grant and consider joining this, because it's got high value and it's a great community. Obviously, it's grown, and to get 65 people from this community onto a cruise certainly speaks to the impact of what she's doing.
Yep, it's going to be fun. I'm looking forward to it.
All right. We're here today with Jeremy Schneider. You may know him as sort of a personal finance aficionado. He runs the Personal Finance Club, and he's just started a new endeavor that we're going to talk about today as well. Jeremy, how are you doing today?
Hi, guys. I'm great. Thank you for having me.
Oh, yeah, it's really exciting. I mean, our audience is really excited. At the end of the show, we got questions for you from our community. So we're going to talk a little bit about a lot of things here: your entrepreneurship journey, robo-advisors, and then your new endeavor, which we'll jump into towards the end. But let me introduce you, because you have quite the interesting history. And bear with me here, guys. Becky wrote a long one, so this may take a couple of minutes. So Jeremy Schneider is a successful entrepreneur and personal finance expert. After starting an internet company in college and selling it at the age of 34 for over $5 million and retiring at 36, Jeremy has dedicated his life to teaching personal finance. He founded First Personal Finance Club, a community of champions of the individual investor who help further financial education. Now, after getting his master's degree in computer science at the University of Michigan, Jeremy turned down a job offer from Microsoft. Instead, he started an internet company called RentLinks, an advertising network for rental properties. At 34, Jeremy sold his company to Appfolio for over $5 million. After taxes, his share came out to $2 million, and there's more involved there. We'll talk about it. He spent the next 2 years working for Appfolio, then left on very good terms. With the amount of money he had invested, he was able to live off the growth without ever having to work again. So guess what? At age 36, Jeremy was officially retired. Now, he's not a late starter, but a lot of what he's learned will apply to our audience. Definitely. He spent the next year traveling and staying at home playing StarCraft 2. So he got lost in the video game screen world, and he was feeling unfulfilled and had, as a lot of us do, an existential crisis about, especially at 36, I would think, oh God, I got a lot of life to live. What happens next? So in 2019, he started a passion project on Instagram to share daily personal finance tips. He now has over 600,000 followers. And that's when Personal Finance Club was born. It pumped me up every day to talk about Roth IRAs and index funds and help people change the course of their financial future. Now, Jeremy kept getting the same questions. So during the height of the pandemic, he was bored. Fancy that. And created an online course on how to build wealth by investing in index funds. And you should take it. In the end of the first week, he had $100,000 worth of sales. That's when he realized that he had accidentally started a business. Jeremy's latest business endeavor is called Nectarine, and we'll jump into that at the end. It's fascinating, and I think will be of great value to our audience. We can't wait to dive into this conversation about investing. Even though our audience is in a different place in life than you are, Jeremy, lots of the same principles apply. So we know there will be lots of actionable tips and great info for our listeners. Jeremy Schneider, welcome to Catching Up to 5.
Wow, that was a long intro. Very good, though. I feel like that's a pretty accurate summary of my story so far.
Well, we like to think that we research our guests, and there's been a few of them that said, well, you know my book better than I do.
Yeah, that's what I was thinking.
So that was pretty quick and robust. Becky, don't you want to know a little bit about the origin story here, as Jeremy says it?
I do. I want to find out kind of, Jeremy, what caused you to start a business while you were still in college? I mean, that's kind of intriguing to me. And also you got out and got an offer from Microsoft. That's probably every software engineer's dream, and you turned it down. So yeah, tell us what your earlier life looked like, just a short version of that.
Yeah, when you read the short bio, it sounds like, oh, it just came easily, or it was always predetermined or something. But I definitely never thought that I was like a start a company kind of guy. And working for Microsoft was my dream. When I was in college, this was between 98 and 02. So it was kind of the peak of the dot-com boom and then bust. But Microsoft was the behemoth tech company, still is. And I really wanted to work there. I desperately wanted, and they were recruiting on our campus. I was like so pumped when I got an internship there. And I actually got 2 internships there. I was like, I didn't think I was really top of my class or anything. So I don't know. I was so pumped to get there. And then I just didn't really like it. I don't know what else to say about that. I mean, great company, very kind people there, everything. But I just didn't look like working for a massive corporation. I didn't like being a cog in the machine. And at 22 years old, when I got this full-time offer, I don't know. I didn't want to do it. It was nothing. Yeah. I don't know. It feels like a very privileged thing to say, and I'm sure that it is. But
I don't think so. I would disagree with you there. I mean, yes, it could sound privileged, but I like the fact that you were self-aware enough to know that wasn't going to work for you. And a lot of us take the carrot that's out there in front of us and then figure it out 5 years later. So yeah, no, I think that's a great thing.
Yeah, I wanted a defined path. Medicine was definitely a defined path where you just had to jump through the hoops, work hard, and at the end of the day, you had a job and a reliable, reasonable, high income. So to take that leap into the unknown, I guess in some ways it's easy as a poor student mentality. You don't know any better. But there's a whole entrepreneurial journey here in starting your company and the sacrifices you made in order to get down the road to selling it for $5 million. Can you take us through that journey, please?
Yeah, I think that the naivety was one of my biggest strengths because I didn't know what I was up against. And I was living extremely frugally in college. A dollar was a lot for me to spend. And I had very little expenses living with roommates, driving the oldest cars. Just I was living on nothing. And so transferring into entrepreneurship actually wasn't that crazy. As weird as it sounds, like if I had moved to Seattle and bought $1 million home and was living on this massive income, and then I started trying to live on nothing, that would be like a much more rocky transition. So in that regard, it was actually a little bit easier. But I had no idea what I was doing. I literally Googled how to start a company. I didn't know if you had like fill out a form or declare it or how you get people to, I knew nothing. I didn't know how to make a product, how to get people to give you money. And I just started trying to sell things to people. I try to sell, I knew technology. I was a programmer by my degree in college. So I started trying to sell websites to, my old landlord and things like that, whatever I could figure out to get people to give me money. And for the first few years, it was pretty rough. Like the first year, my company's top line revenue was $14,000. And then you subtract the few expenses I had, technology or hosting or whatever, maybe I took home $10,000. And this was the year 2003 or something like that. So in today's numbers, maybe that was 15,000 or 20,000 or whatever, but still I couldn't even afford the most meager of groceries on that. And so I was living on credit cards. And so that first year, just to subsidize my grocery bill, I lived on a credit card, and that continued for a couple of years. During that time, my mom actually joined the company. She had a computer science degree from the University of Michigan. I'm 43 now. My mom, I'm not going to disclose her age, but she's the age of someone who has a 43-year-old kid. And so it's unusual to be a woman of that age, but not that unusual because someone else on this call apparently is in her company that has a computer science degree like Becky does, right?
Yes, I do. I do. It's ancient technology, but yeah, that's what I graduated with. So
yeah, you were using punch cards, right, Becky?
Absolutely. I was carrying boxes of punch cards. Yep.
As were my parents. My dad was in that industry too. So it's kind of, I guess, my family industry. But yeah, my mom was kind of between careers herself, and she was helping me out because she had worked for a small company earlier. And so she decided to join the company, and I sold her 30% of the company for basically the book value, which is how much cash we had in the bank. And so I think I had $5,000 cash in the bank to basically cover our operating expenses. And so she gave me a $1,500 check to buy 30% of the company and basically come volunteer as an employee, as I basically was. But then over the years, we started doing better. We figured it out. We grew. And then, the end of the story, which is in another 8 years later or something, I sold it for over $5 million. And so my mom's $1,500 check turned into a nice little retirement parting gift of about $1.5 million for her. So that was nice to basically be able to retire my mom with this success of the company.
Nice.
But how did you run the business? Because you have a uniquely progressive approach in growing it and taking on employees. Take us through that mentality as a leader of your corporation.
So I always did, and still largely do, just like see myself as like a Silicon Valley outsider. I didn't really know how to like raise venture capital, and it didn't seem very natural to me to go ask people for millions of dollars. And then what do I do? How do I know what to do with that? So I just kind of made money the old-fashioned way, which is selling our service and then spending less than we made. And it turns out that programmers are very expensive, and I was a pretty good programmer. And so instead of hiring programmers, I would do the programming and I'd hire people around me. And also to fuel the growth of the business, instead of trying to like sit on my ivory tower and be the highest paid employee and drain the company of cash, I was the lowest paid employee. And I think I was inspired by this reading like an Inc. magazine back in the 90s or something. And I honestly don't think I could even find it, but I read about some other entrepreneur who just always made himself the lowest paid employee as a matter of, I don't know, fairness or leadership or whatever it was. And I was like, that's cool. Like, I don't know. It just really inspired me. Like, yeah, why do you have to be the highest paid employee? And so I always paid myself the same as whoever was the lowest paid employee. And it was both, I think, like an act of leadership and an act of necessity, because we didn't have any money. I couldn't pay myself $200,000 a year. We would have gone bankrupt.
Well, that's interesting because your philosophy in running a business is, I think, incredibly modern. It's really a green philosophy. You talk about the principles of giving, abundance, humility, and charity. Can you tell us how you applied those in your business?
Yeah. I don't know if it's modern or not. I was just a kid. I still feel like I'm pretty young, but back then I was in my 20s. And so I was just trying to figure things out. And so, for example, when I think I got my first or second employee, one of them asked about PTO, like how much paid time off do they get? And I think I probably had to ask them what PTO meant because I had never used that. I never had a job and I'd never used that term. And then the idea of me kind of like high and mighty being like, this is how many days you're allowed to take vacation was really weird because I was like, I didn't have that restriction. I could take as many days off as I want. And so I was like, well, I'm not here to police how many hours your butt is in the seat. I'm here to, like, same as you, hopefully build a company that's making something cool and helping people and growing. And so I'll give you the same policy I have, which is you can take as much as you want and you won't be measured by how many days your butt's in the seat. You'll be measured the same way I am, which is by the success of our work. And I thought, I was like, I felt good about that. And they seemed to like it. But then, a few months or maybe a year went by and I kind of noticed that nobody was, and I like talked to a few of my employees, and there's never a big company. We had 7 of us total when I sold the company. So I don't mean to like throw around the word few, like there was hundreds. There weren't, when I say few, I probably meant 2, maybe 3. And I said, why aren't you taking, you have unlimited PTO, like why haven't you gone on vacation or whatever? And they just basically felt an obligation not to abuse it. They're like, oh, well, and you're not, or they're not, or the other employees aren't. And so I was like, okay, that's like really nice. That's cool that I have people who care about this and don't want to feel like they're abusing the system. But also that wasn't the point. It wasn't to make people work more. And so I was like, all right, I still like unlimited PTO because I just hate the idea of someone going to a dentist appointment and having to like log how many hours they didn't work. Like that just still to this day, like makes me cringe. That like, what a terrible way to manage people. But so I implemented a new rule, which is called minimum required PTO, which I still don't really hear many other companies doing. Maybe it's still unique in the world, but I basically said, all right, every single quarter, every 3 months, you're required to take a week off. You have to not work. I don't care if you don't have to go home, but you can't stay here, like they say at the bar or whatever. And so then, I think that kind of like was a press release. I was like, okay, now I'm booking trips, or maybe I could book a 2-week trip and have it bridge or it can be 2.5-week trip because I still get unlimited PTO, and then like dentist appointments. So the unlimited PTO thing was always enforced, but at least then I think the minimum PTO thing kind of made it nicer for people to not feel an obligation that they could take 0. And it worked, by the way.
That's such a unique idea.
Yeah, other principles you talk about are humility and giving. Your mentality really was one of giving first. And when your growth, in the talk you gave actually at Economy, a conference that we highly recommend is coming up in March. You were there on the second conference. And the other principles of humility and giving play a huge role in your personal and professional life. Tell us how you implement those.
I just think you do better if you are charitable. I think that you personally do better. I also think it's like a nicer way to live rather than trying to like grab what you think should be yours rather than just being generous, because I think it comes back to you and more. And so, for example, with my employees, my first company, I implemented a stock program. It was an LLC and I didn't really know what I was doing. So I didn't actually create stock, but we created something called like phantom stock where we basically gave shares. And I had one employee who I hired, her previous job was at a temp agency and she started working for $12 an hour and she was just crushing. And I knew that our job was better than her previous temp job. And so I could have just kept paying her the minimum that she like would have been willing to work for. But I kind of like proactively was giving her raises, and like, because I knew as just like a business owner, I was like, she's doing the work of 3 people. And so if I'm paying her the salary of 2 people, I'm getting a crazy good deal. And so I kept giving her like unscheduled raises because I was like, wow, this is like, you're doing great. And at one point she's like, kept giving, maybe I'm like exaggerating, but definitely more than annually. And at one point she turned it down and she's like, no, like, let's use it for the company and my salary's fine. And so then I was like, okay, maybe I can just give her part of the company. And so I implemented the profit units. And then, when we sold the company, I wrote her like a nice big 6-figure check. She bought a house. So it was, and like I said, it works because I had employees who, even the word employees, I like hate hearing the sound of it come out of my mouth. I feel like they're like friends or coworkers, or team members, or whatever cliche businesses use. But like they were part of my business and they really cared and they wanted to work and they weren't fighting against me. They were fighting with me. And so, yeah, I don't know. That's an example.
And that comes from the top, Jeremy. That attitude comes from the leadership. I know that you showed them the way you exemplified that. And I love your idea of giving. I know that if you give with the wrong motivation, then it's not usually a good thing. But if you give without any expectation of return, it almost always comes back to you multiplied. So, yeah. And I love that's a good heart.
And giving for you wasn't just internal. It was external. As part of how you organized the company, you created some charitable, before you took it from your revenue and minimized your profits because you had organized the giving policy. Can you tell us how you did that and how it affected your employees as well? Oh, partners, sorry, team members.
I don't know. I hate where employees are some like corporate speak euphemism for employees. I'm not sure. Let's just call them subordinates and just really lean into it. I'm just kidding. Yeah, thanks for reminding me. Actually, when you said giving, I was like, oh no, I'll organize my brain that way. But these leading questions are helpful. Yeah, at RentLinks, my first company, I was on a trip at one point. I was very lucky to travel, although I always traveled to very poor countries because I couldn't afford to travel to Europe. So I traveled to like Peru and South America. I think I was in Central America, and I think I was in, honestly, I think it was Peru. And I saw like a kid on the bus. We were like taking a bus somewhere, and he was like begging for money. And I honestly don't know what the deal was. I don't know if he had parents, if it was a scam, if like, I don't know the background of this child, but I do know that sucks that if it was in the US, we wouldn't want kids doing that, whether or not it was a scam or if it was legitimately needing the money. And I just thought like, even though I was like living on $36,000 a year at the time, it wasn't like I was like a millionaire or whatever. I was like, that sucks. And like, I should be doing more because clearly like my means are better than his means. And so I heard about this thing that's called 1% for the world, which is basically, I'm pretty sure it's called a very similar phrase to that, which is basically this idea that if every corporation just took 1% of their sales, their net revenue, their top line sales, and gave it to good causes, that we could basically solve the world's problems. And I was like, that sounds great. 1% sounds small, so I decided to do 2%. And so for the entirety of my company from that day forward, we just took 2% of our sales and actually split it equally among our employees and let all 7 of us choose whatever charity they wanted. And it was good because it just felt like you can only get so inspired by selling rental housing advertising. Like I could make a case that what we were doing was good for the world. It made better available information to people who are looking for housing and things like that. But it's only so inspiring. And so that was good. And then when I started Personal Finance Club, I was in a very different financial situation. Like you mentioned, I didn't ever need to work again. And for the first almost 2 years, there was no revenue. I didn't sell anything. It was just a passion project. I was trying to help people. And then I decided to sell a video course. I sold it for about $50. In the first week, like you mentioned, I sold $100,000. I was like, oh, dang, that's a lot of money. And so I was like, okay, I'm going to implement the same giving program. But instead of 2%, that seems a little bit too modest now. Let's just make it 20%. And so I was giving 20% of revenue to charity. And we did that for years. I've recently changed it, full disclosure, and we've announced this on our website and everything. Now it's 25%, but 25% of profit. And the reason is because as we were adding, now I have 2 full-time employees and more expenses and things like that, the 20% basically was causing us to become unprofitable and lose money, which would eventually cause us to go out of business or fire people. And so 25% profit at least makes sure that we're not going to be unprofitable, but hopefully we'll grow to be even a bigger number one day as profits increase. And we've donated from Personal Finance Club to date, I think $273,000, which is, I'm obviously doing better now, but that's still an insane amount of money to me. I think it's like maybe more money than I've ever spent personally in my life. Yeah. So the way I think about it is just, we want to be an engine for good. We teach good things, we help people, we give money away, and it's a pretty nice way to live if you can make a living doing it.
Absolutely. That's wonderful.
So actually, your principles are outlined in a book that I think I've mentioned before on the podcast, but I wanted to dive into it a little bit because it's like you wrote this book. It's called The Go-Giver, a little story about powerful business idea, and it's often read in business school. It's by Bob Burg and John D. Mann. It's a story about the power of giving. And then there's a salesman that is more of a taker than a giver. He's ambitious. His name is Joe, of course. And it seems like his hard work and efforts are not paying off in terms of results. And then following a disappointing quarter of sales, he seeks out the mentorship of somebody in the book called the chairman. And this is really a parable. He embarks on a learning journey of meeting go-givers who are friends of the chairman. And through those interactions, he learns what they refer to in the book as the 5 laws of stratospheric success, and which I think you've achieved, actually, Jeremy. And one of the laws is value. Your true worth is determined by how much more you give in value than you take in payment. I guess you did that. So you did read the book. And then number 2 is compensation. Your income is determined by how many people you serve and how well you serve them. Yeah, it sounds like something you've been doing. Number 3 is influence. Your influence is determined by how abundantly you place other people's interests first. Guess what? You did that both internally and externally. Have you read this book, Jeremy?
Well, we had a meeting ahead of time, like a pre-podcast meeting, and you assigned this book to me as a reading assignment. And I'd never heard of it. So to hear that you just now say that it sounds like I wrote it is like extremely flattering, because I did read it. I finished my homework assignment, and I don't know, I loved it. It was interesting because I didn't know what the book was about before you assigned it. And I thought that it was like a book on charity, but it's actually like a business book. But it's really, I don't know, I love it because it says that like you don't have to be stepping on throats to get ahead. That's not really how it works. And yeah, definitely a lot of these laws ring true both with my first company and with Personal Finance Club. And honestly, I just feel like I maybe got lucky. I wasn't like, I wish if I had known these rules, I would have just done them. But now just looking back, I just got lucky. I was like, oh, I happened to have backed into it. So that's a little bit of luck, I guess.
Well, if you'd gone to work for Microsoft, you'd have learned different rules, right?
Yeah, maybe.
And there were 2 more rules before I let this go. And number 4 was authenticity. The most valuable gift you have to offer is yourself. Just being authentic, transparent, which you are as well, and vulnerable, imbues trust in people. And that's the lead from behind kind of approach, as opposed to stepping on throats, as you say. And then the last law from the chairman is receptivity. The key to effective giving is to stay open to receiving. So if you give, you'll receive exponentially. And I think that's true even for late starters. They worry about hoarding, and sometimes they got to save. But especially in the entrepreneurial world, but in our own world, giving, and we've talked about this on another show called Go Giving, it really pays us dividends, right, Becky?
Oh, it does. And I wanted to tell you one thing I learned back. I mean, I'm assuming most of the people in our audience know our stories, our backstories. And there was a period of time when Stephen and I were in what I call the dark days. And Jeremy, like you, I was buying groceries on credit cards, but it was for a completely different reason. It was because we had been stupid. And there were people in our circle of friends and family that wanted to help us out. And we would come home sometimes and find an envelope taped to the garage door with like Kroger gift cards in it. And all of us want to be givers, and it's extremely hard to be the receiver. I know this is a different kind of receiver than what the book is talking about, but there was a point in our life when we had to be the receivers, and it's tough. And I had a friend tell me, don't steal my joy. She was getting joy out of helping us, as probably all of us do. We get an internal feel good when we know that we have helped somebody else. And so that's something I wanted to say to our audience. If you find yourself in a position of having to receive, then do it graciously. But don't throw up a wall and say, oh, no, I can't do that. That's not me. Because you are literally stealing their joy.
Yeah. And then you've taken these principles into Personal Finance Club, as you mentioned. And I want to talk a little bit about Personal Finance Club, because you have a way of, achieving simplicity. In your Instagram posts, which you post daily, in one screenshot, you're able to say so much about personal finance and investing. I mean, it's just absolutely incredible to me. And I love following them because they're humorous and poignant. And then I wanted to share my screen for a moment, and this may entice people to go to the video, go to our YouTube channel. Okay. So if you can see it, I've got your top 9 posts of 2023 up here. And then you say, do any surprise you? No, one of your top posts is, how rich is Elon? And you go through a bar graph of, and that was your number 1 post, of what it's like for the median American. And so if you got that one, and then you go into one called Cost of a Child. I mean, I don't know where you come up with these ideas, but you really hit it out of the park. This is your number 2 post, and you figure out that it's $310,000 to raise a child. And this has increased 4 times faster than regular inflation. I bet you college costs is a huge part of that. And then the next one, I love this one, casino gambling versus day trading. 13 out of 100 gamblers leave the casino a winner. 1 out of 100 day traders reliably beat the market. And this comes back to the simplicity principle that you talk about that we're also going to go into sort of with your investing philosophy. I love this one too, because the next one is the stay-at-home mom. And we underappreciate this. And you have these great emojis, and you come up with these great names. And it says here that Ed works 1 full-time job and his annual income is $90K. But then Eve is a stay-at-home mom whose annual income is 0, but she has unpaid jobs in daycare, chauffeur, personal chef, house cleaner, personal shopper, and event planner. And you put the salaries of each of those people in there annually, and you come up with $183,000 a year. What's incredible when you put numbers to it, and you put numbers to all these things. Now, there's more posts there. I don't want to beat this dead horse, but you've got to go to this. You got to subscribe to the newsletter, go to the Instagram, and just enjoy these. Because how did you come up with this idea, and how do you affect this? You really distill things down to their essence.
Well, thank you. That's extremely flattering. I do think those 5 rules of giving are almost like a playbook for social media success, as silly as it sounds. Like when you see someone on social media who's not successful, they're like, buy my thing, click my link in bio, like, let me advertise to you. But when you just give with no expectation, and so our whole strategy, and like I said, I just read that The Go-Giver like in the last couple of weeks. So it's been like this for 5 years now. It's just to like endlessly give with a rare ask. We rarely mention a course or anything like that. And so I think that's like the core of it. And then I think the Instagram format is part of it, where I was trying to figure out what was connecting with people, and you only get one little square. And so you have no choice but to be incredibly brief and figure out how to make it punchy. And then a lot of it was just kind of a feedback loop from followers. From my first, if you scroll way back 5 years ago, my first few posts were terrible. I had some posts where I was like a video of myself being like, is now a good time to buy T-bills? And I was talking about interest rates and like, it was just crickets. And I like asked people, I was like, why didn't you like this video? And they're like, oh, I don't know what a T-bill is. And I was like, oh, it's a bond. And they said, I don't know what a bond is. And I was like, oh, I am not speaking to my audience right now. And so then a much more successful post would be like, what is a bond? But I'd have like, Bill and Becky are actually, you guys have nice alliterative names. Bill could be an Instagram post, but Bill and Becky, whatever. And I just try to make a story up about it. And then I think there's like around personal finance, especially late starters, I just feel like there's this shame that like we all feel that we're all, I don't know how a 401k works. I don't know what a bond is. Everyone else is ahead of me. I have debt and no one else does. Like, and almost all those things are not true. Everyone is in that situation. And so when I can make a little emoji laden graphic that's like very friendly looking, and emojis, I've tried for very briefly to depart from the emojis, and the post didn't do well because it's not as friendly looking. And emojis they're on all our phones. We use them to communicate with each other. And they're free. I hope I'm not going to like violate any copyright laws by using them. So I just think having like this friendly emoji laden, very simple graphic speaks to people who have felt shame. They're like, okay, he's saying what is a bond? And I feel safe from the comfort of my phone in my home and be like, thank you for telling me what a bond is. Like, no one's ever taught me that before, and I've been too afraid to ask because I thought everyone else knew. Then when you see how successful I post, I was like, nobody knows what a bond is. Some people do, but most people don't. So I think that's how we try to connect with people.
Well, you talk about being a white mansplainer to people living in poverty, which I thought was great. And you are playing to, in some ways, the late starters that are at ground zero and don't know where to start. Your audience may also be the early starters, whereas how do I learn simply investing principles? And I know Becky and I would be honored if you did a post with Bill as one of them, Becky is the other, and a late starter post.
I'm writing that down right now. I mean, that's perfect because you can see from this screen, like we almost always do, like not always, but we often have emojis of both genders with a litter of names like Sam and Sarah. I'm showing on the screen right now. And so Bill and Becky late starters, that's coming. That's perfect. It's written
awesome.
itself already.
Awesome. We'll be famous.
And we'll put it on our Facebook group, which has grown exponentially recently. And I want to thank our audience for doing that. We're almost at 9,000 members to the community, which, if I'm not mistaken, is about as big as the community you have on Facebook. So we've seen some great.
That's the same size of our Facebook group.
Yeah.
Although in our comparisons, there's usually like a better decision maker and a poorer decision maker. So I'm not sure who's going to win between Bill and Becky. We'll have to find out.
Oh, we have to arm wrestle for it.
Yeah.
Oh, let me lose because Becky is a big winner. I'm happy to be the loser. No problem there.
Oh my God.
You can do it on lifestyle inflation. And Becky had boats. I had a boat. And we definitely succumb to lifestyle inflation and paycheck to paychecks. Or we can both be losers and share mistakes so that people can learn from them.
Oh, I'll be the loser as long as you show me in a race car.
Oh, there you go. One of the principles you have with the Personal Finance Club is simplicity. You have 2 rules, and they're on every post that you write. It's live below your means, invest early and often. And then you also have a very simplistic approach to investing, or you may not subscribe to that in your own portfolio because of a little bit of messiness along the way. But I loved your take on sort of a 1, 2, 3 fund portfolio, especially with regards to being truly passive. What do you think is your ideal portfolio if you were to start again?
My ideal portfolio is one single fund, which is a target date index fund based on your birth year plus 65 or 70. I think that's optimal investing. And I don't think it's optimal because it's simple. It's convenient that it's simple. I think it's optimal because it's going to beat the vast majority of investors. And the ones who beat you are more likely lucky than good. I think there's like an actual positive financial dollar amount to simplicity. And the investing world can be infinitely complex. It's crazy what you can do in the investing world, like derivatives and futures and options and commodities and day trading, and it can be anything. But the more I read, the more I learn, the more I live, the more I see, the more I strongly believe that is all nonsense. And if it benefits anyone, it benefits the financial services industry who's selling that nonsense with high fees. It doesn't benefit the individual investor. And investing is different than most things in the world in that less is more. Usually more is more. Maybe that there's some other parallels where less is more. But if I'm talking about fitness, basically the more effort you put in, the better, generally speaking. Like if you do nothing, just order fast food and sit on your couch all day, that will be very little effort and you will have very poor fitness results. But if you take an hour of every day and make a plan and stick to a fitness regime and watch what you're eating or buy local vegetables and eat healthy and put more effort in, generally you're going to have dramatically better results, right? Same for work at your job. If you are in sales or whatever, and you just do the minimum every day, you're probably going to have pretty poor results. But if you are working harder, working longer, working smarter, working more cleverly, you're going to have better results. And so in investing, I think people just assume that's also true. And so when people get into the investing world, they say, okay, how do I make this more complex? They're finally like, I've been avoiding this for 20 years. I got to learn, show me derivatives, options, futures trading, because that must be the best, because that seems super complicated. But it's not. It literally makes less money. And the reason behind it is just the nature of the efficient market. The stock market's very efficient, because we could have a whole separate hour and a half podcast me ranting about this. In fact, I have an 8-hour course where I rant about this. But basically, the market's efficient because so many people are participating in the market. Trying to fight them for your piece of the pie is just kind of like a losing proposition. They say the more your portfolio, your investments are like a bar of soap. The more you touch it, the smaller it gets. The optimal way to invest is to put your money in, minimize your fees. Don't be paying high fees to actively manage mutual funds or financial advisors or anything that's going to slowly erode your gains, and then just leave it. Our recently departed Charlie Munger said the money's not made in the buying or the selling, it's in the holding. And so optimal investing is just putting your money in early and often, as I say. And you might be saying, hey, I'm in my 40s or 50s or whatever, I missed early. I was like, no, you're still young. If you're 50, for example, today, and you look at the actuarial tables, I think the average lifespan in the US is like late 70s right now. But if you're 50, your lifespan's actually mid to late 80s, because you have managed not to die up until this point, which is those early deaths bring the average lifespan down. And so you're still looking at a 30 to, and that's average, right? Hopefully we beat average. We should at least plan for that. So you might be looking at 30 or 40 years of life ahead of you. And so there's no reason to think it's too late, I shouldn't start. It's all the more reason to get started. And so, yeah, I know I could... Sorry, you asked me about investing. I get very excited. I could talk forever, but the answer, a simple target date index fund, low fee, just put the money in when you have it. Don't time the market. Don't get tricky. The less tricky, the best. I always say invest like a sociopathic robot. You hear about the Middle East, you hear about Ukraine, you hear about inflation, you hear about recession, like all the bad news, invest. Good news, invest. Bad news, invest. Tuesday, invest. Friday, invest. Just when you got money, stick it in there. Don't read the news. Don't worry about it. Let it grow over time. Check it every 10 or 20 years and you'll do fantastically.
With our audience that does tend to be older, I think that probably all of us understand that we don't have time to make a lot of mistakes. So we feel like we've got to get it right away. And I think that unfortunately, some people feel like they've also got to be a little riskier in order to catch up to those years that they let go by. What is your take on that, on the risk?
Yeah, I get questions from late starters. I say, hey, invest for these decades and your money will grow like this. And then I get questions from late starters and they say, okay, but what do? I need to take the shortcut. And the answer is there is no shortcut. In fact, get rich quick is stay broke forever. And in fact, if you're 50 and you try to do something really tricky for 5 years and then you fall flat on your face and then you're 55 and you're in much worse shape. Like those 5 years could have been dramatically beneficial by just investing the simple way. And so I would absolutely not do that. I would not invest more aggressively. In fact, I might invest a little bit more conservatively, because the long-term benefits of compound growth are less extreme when you're starting later, and just the saving aspect is more important. And when you're going to need that money, you don't want the money to dramatically drop and when you actually start spending it. So that's why I like target date index funds, because they basically set the aggressiveness level for you. It's disappointing to hear that. I wish I could tell people, oh yeah, just get more aggressive. But if I knew how to do that at 50, I'd be doing it at 20 and we'd all be trillionaires, you know? The reality is here's the good news. The bad news is I don't know a shortcut. The good news is a few things are different in your 50s and your 20s. First, you're probably way more focused. 20-year-olds are idiots. And I know as a former 20-year-old, and that's not true. If you're 20 and listen to this, you're probably a very smart individual. But 20-year-olds are going through a lot in their life. They're in college, they're moving, they're figuring out how to date, they're trying to figure out how insurance works, they're going there first. There's tons of things. They're not focused on saving or investing for retirement, right? And when you're 50, you're much more focused. Also, often in our 50s, we have more income. We're further in our career, things like that. I'm just using 50 as an example. This is true in your 30s and 40s too. So while as a 20-year-old, you might have this like magical opportunity of compound growth that I love to draw with emojis and Instagram charts, but in your 50s, you have this magical power of income and focus. And so while $200 a month might grow to millions of dollars over the course of 40 years, $2,000 a month can grow to millions much, much quicker. And so the solution isn't get more aggressive, get tricky, buy an insurance scam, start day trading. That's not the answer. The answer is put more money in. And you have that opportunity when you have more income and more focus.
I have an idea I want to run by you because it's kind of where I'm moving, and I had succumbed to a bit of complexity. And you mentioned robotic approaches, and we're going to talk about robo-advisors in a minute. But what do you think about a total world and short-term treasuries as your portfolio?
Love it. A+.
I mean, that's a two-fund portfolio that people don't talk about. I think Becky's in VTI and short-term treasuries, which is VTSAX and short-term treasuries. People talk about doing BND or the intermediate term total U.S. bond fund, but that's a bit archaic because you don't want to take corporate bond risk, and it's intermediate duration, which we can talk about sometime. But where I'm migrating from a Paul Merriman portfolio or 3, 4, 5 funds is VTST and chill. You heard it here first, guys.
I like it. I like it. So, Jeremy, I want to circle back just a minute. Kind of like the what's a bond idea we were talking about earlier. You mentioned target date funds. So give us just the thimble explanation of a target date fund. And then how were you talking about calculating it with your age?
Okay, so a target date fund is basically one fund you could buy that has essentially a 3-fund portfolio inside of it. And the 3 funds are a total U.S. stock market. So you're basically buying every single stock in the entire U.S. It also contains a total non-U.S. stock market index fund, which basically means you're buying every single stock not in the U.S. And as Bill just mentioned, it's a little bit weird when we're in this American-centric view of the world where we split them up. Why not just call it the world, which I totally agree. And so we could even simplify it to say total world stock market index fund, and then a total bond market index fund. And so it basically has this fully diversified, it basically buys everything for you all in one. And again, the reason why you want to buy everything is because the stock market's efficient, and buying specific things introduces you into more risk and more opportunity to lose to the market, where buying everything diversifies away all risk and guarantees you your fair share of all the growth of the world's companies and bonds. And then in addition to automatically setting that asset allocation, buying everything for you in a single package, it also rebalances for you. So for example, if next year the US has a bad year and international is a great year, it makes sure you buy more US stocks and less international stocks to achieve the benefits of rebalancing, and it reallocates for you. So when I talk to maybe 40 and 50-year-olds, they're still very aggressive, like you mentioned, I want to get ahead. But when I talk to 70-year-olds, they're not aggressive. They want their money. And so the question is, when they want income from their portfolio that they've spent the last 20 years building, and they want that portfolio not to go and get cut in half when the next crazy president does the next crazy thing or whatever. And so when do you make that transition from stocks to bonds, from more aggressive to more conservative? And the answer shouldn't be in some sort of knee-jerk reaction to some sort of geopolitical or macro financial situation. The answer should be slowly along the way, because if you do it any other way, you're basically trying to time the market, which is going to hurt you. And that's exactly what a target date fund does for you. Bill, you mentioned just the 2-fund portfolio. I think that's fine too. Like I said, when I talk to 70-year-olds, I'm more conservative, but I'd rather people go, I hate to see people who have $1 million portfolio, it cuts to a $500,000 portfolio, and then they decide to become more conservative. I'd rather people decide to be more aggressive. They're like, okay, I'm 70, I have too many bonds, now I'm going to introduce more stocks. But you don't see that. You see people make the mistake the other way, which is why I like the kind of forced glide path towards bonds that a target date index fund offers.
We're going to have to talk about target date funds in an episode, because it's not exactly as simple as you described, because there's actively managed target date funds. There's target date funds that have multiple ETFs in them because it's designed by an active manager. I think the one you're referring to is largely similar to, say, a Vanguard target date fund, and others may do it, and expense ratios can vary. So you got to be a little careful to be what you're looking at and what you're investing in, as you always do. We'll talk about that more, but we want to move on because we want to talk a little bit about robo-advisors. And the reason I want to bring this up is you think they're simple, and they market themselves as simple. And just to give people an idea of what they are, It's an affordable digital financial service that uses technology to help automate investing based on information investors provide about themselves and their financial situation. Robo refers to these services being almost completely digital, in that computers, smartphones, and tablets are used to access and interact with your accounts. Advisor speaks to the investment advisors that offer digital advice and account management services, often for a lower fee than traditional investment advisory services. They'll ask you your risk tolerance questionnaire and your investment needs. They'll auto build a diversified portfolio of funds, but it can be many. It doesn't have to be three. They can be managing a complex portfolio for you, and you got to look under the hood, right? It'll automatically rebalance. You may, in a graduated plan, have the basic digital and then a hybrid robo and then the full traditional. To know how big these things are and have become, in 2015, there was $47 billion under management by robo-advisors. In 2016, it was $98 billion. And in 2024, they project $1.2 trillion will be managed by robo-advisors. They're all different. Jeremy, what do you think about robo-advisors? And are they really simple? Or is it just complexity masqueraded in pseudo-simplicity? And are you really buying active management?
Largely, I like them. And the reason I like them is because people do a really good job of tripping over themselves. Obviously, not everyone needs one. And frankly, if you're the kind of person who's listening to Catching Up to Fi, you have distinguished yourself as someone who's going out of your way to learn the basics. And so if you're listening to this, maybe I'm not describing you right now, but what I will say is when I look at a normal average person's portfolio, probably half the time I look at it, they've made this crippling error of leaving their some or all of their portfolio in cash because they didn't know that investing is a two-step process. Step one, put money into the account. Step two, buy an investment. They thought putting money into the account was investing. Yep. And so when we talk about the nuances about robo-advisors, I'm like, can I swear? Fuck nuance. You can bleep that if you want, but fuck nuance. People are sitting 100% in cash. Let's just if what they need is a beautiful Silicon Valley app that they Venmo money in, and it gets pretty darn close to the right thing. That's so much better than the crippling mistake of not investing. It's also so much better than the crippling mistake of going all into ARKK because you read one article on Kathy Wood on Instagram. It's also better than panic selling because you are trying to manage your own Robinhood account. And so I'd say the benefits for an average investor, which I have a relatively low expectation of knowledge of the average investor, is great. That said, you're right. There's critiques to be made. They're relatively new. We don't really know what their track record is. They do charge a small fee. I think it's small enough that I don't get beat up over a 0.25% fee because, like I said, the other mistakes are so deadly. I do think they pull some tricks where they make it more complex than they need to under the hood. Like a robo-advisor could just be like an app where it's like, click here and we're going to put your money in VT and BNDW or something, some supremely simple portfolio. That would be a great robo-advisor, in my opinion. They make it more complex than they need to because they are in the business of making people think that they're doing something. And so they buy 9 ETFs. I haven't seen any RDQs of what I would call active management, really. I don't think they're picking and choosing stocks for a higher fee. I guess maybe there's something active about giving you different options about how aggressive you want the portfolio to be. But largely, I like it. That said, I don't go around suggesting them largely. I think people should still learn the basics of investing so that they can open their own Vanguard account and do it right. Because I guess another critique of robos is if you don't know what the heck they're doing, you might not stay the course and you might pull it out and then go buy some insurance scam or something like that. Mm-hmm. So there's still obviously a huge value to education, but yeah, I'm not a robo hater.
Yeah, I mean, there's all the big institutions have created them: Vanguard, Fidelity. There's also Betterment and Wealthfront, and Schwab does one. They're all different. I was looking under the hood, and rather than go through the details, let's just say that we'll put some of the details I discovered in the show notes. Some, like Fidelity Go, promote themselves as zero advisory fee under 25K with no minimum, and a lot of others have minimums like Vanguard. But interestingly, if you look at it for the cost, they charge 35 bips for the balances over 25K, which is basically your expense ratio plus the cost of advisory funds, because they're more than the 15 bips that Vanguard will cost you. You've really got to look under the hood of these, because one robo-advisor is not the same as the other. And like I said, we'll put some of the details and differences in the show notes. They do manage all different kinds of accounts, except for 401ks. They do traditional tax advantaged accounts, all the versions of an IRA, and then they'll do your taxable accounts. And that gives us an opportunity to talk about, because they really promote tax loss harvesting. Can you take us through what that is? And is that really advantage? Because that's their big marketing ploy.
I think that's their own, when they're speaking to people who understand investing, that's the only thing they can suggest that might give them an edge on actual performance, right? Like, people who know what they're doing know that you could just go buy VTI, VXUS, and BND and do everything the robo is doing with 5 minutes of work. And so what tax loss harvesting is, that say you have 3 funds, one of them has a big gain this year, one of them has a big loss this year. You can basically sell the fund that's at a loss and then claim the loss on your taxes, and then buy there's a rule, the government doesn't let you buy the same exact fund back instantly. That would be a wash sale, basically saying you can't sell a fund at a loss and instantly buy it just to lock in the losses. But you can buy like a pretty similar fund, and who knows if the SEC or the federal government's ever going to crack down on that. But basically then that gives you a loss to claim on your taxes to offset gains from either this year or for future years or whatever. And by pushing tax, and it doesn't, you still are on the net, you're still going to pay tax on all your gains. Like it all comes on the wash down the road somewhere, but people love kicking their tax bill down the road. Personally, I think the marketing on the tax loss harvesting is way overstated. Like every time I put into a spreadsheet and try to do an analysis, it's like you think of the most extreme scenarios, like highest tax rate or whatever. It just is rounding error to me, and it's adding complexity. And if the complexity is, it might show up on your taxes. I don't know. I don't like the tax loss harvesting thing. Like in specific, talk to your CPA. I'm not your CPA. I'm not a CPA. And so for sure, in your situation, if you have like a huge gain and you're in a really high tax bracket and you have an opportunity this year to do something to realize a loss, but in terms of like automating it from a robo being like a net benefit to everyone who uses it, I don't really buy that. I think it's overstated.
Jeremy, who would you suggest? You mentioned earlier about it's better than if somebody has their stuff just sitting in cash. So if someone's like, I've got some investments to make, I need to start growing my money, would you suggest a robo-advisor, or would you suggest that they look at a different path first?
So I know he's not a late starter, he's an earlier starter, but I sat down with my 18-year-old nephew a few weeks ago, who on his 18th birthday, I gave him $1,000 to be used to start his investment career. And I asked him, what kind of investor are you? Do you want to do this stuff? Do you want to be watching the funds? Do you want to be making the trades? Do you want to be like really understanding what's going on? Or do you just want to put it in somewhere and then like just see a balance every once in a while? And that was a legitimate question. It wasn't supposed to be a rhetorical question, because I'm the first kind. Like, I want my hands dirty. I want to really know what's going on. And understandably, he's 18. He's going to college. Like, he's trying to figure out how to date girls, or listen to this, Eli. I don't know what you're trying to date, or so I'm just trying more generally about 18-year-olds. And he's like, I just want to put it in and not know what's going on. And I was like, all right, if that's you, if that describes you, I would probably go to Betterment or Wealthfront. The ones that are integrated with Fidelity and Vanguard, it's just kind of like Fidelity and Vanguard already have 50,000 options, and now they have 50,001 options. And it's like, I don't know, it doesn't really, the simplicity benefit I don't really see there. But Betterment and Wealthfront, all they do is this, and they're really easy apps. They're beautifully simple. They're fast. So we opened up a Betterment account for him. He put in his $1,000. I think my mom matched and gave him $2,000. And now I'm resting pretty easy knowing that like his investments are doing what they're supposed to do.
Okay. Awesome. So let's go to the next step. If an investor doesn't want to do a robo-advisor, but they do want some help, then a live person is an option. So tell us, what can a live financial advisor do for you? Give us some advantages and disadvantages.
I think the benefit of talking to a human, we live in this AI world, we live in the internet world, robo world, but I still think that humans connect with humans. And I think that humans can respond instantly to your actual situation. They can explain things in a way that you need to have them explained to you. They can look at your account. They can fill you with confidence with the decisions you're making, understand the nuance of why your situation might be different. I think there's tons of things that, and when we talk about robo-advisor, there's no real advising going on. They're not giving you any sort of advice. They're just literally putting your money into ETFs. And so I think there's still a place for human advisors. But the problem with human advisors, in my opinion, is basically the way they charge. There's two primary business models. One is your, what I call strip mall financial advisors, where you walk into a strip mall financial advisor and then they sell you a bunch of crappy products. They're just salespeople. And this is, I think, what we're all afraid of from the financial services industry. It's like if you talk to someone, they're going to be some shark who's trying to sell you some garbage. And that's largely true for a lot of them, right? And so if you go to your strip mall financial advisor, they're going to sell you funds that have loads and high fees and account fees and annual fees and yada, yada, yada. And like their goal for their business is to sell you the thing that they want to sell you, not to actually give you any advice at all. The other primary business model is like an assets under management business model, where those financial advisors, their whole purpose of being is to get you to give them all of your money to manage, and they're going to manage it for you. And then they charge you a % or so of assets under management. So if you have $1 million, they charge you $10,000. And that's not horrible. That's the better of the two, I'd say. But over time, losing a % of your gain over time can be pretty dramatic. I think over a 40-year investing career. And like I said, if you're 40, you're hoping to live to at least 80. It can cost you about a third of your portfolio, right? So if you end up with $3 million, you gave the dude that had the money in his account $1 million. That seems like too much. And so, spoiler alert, you kind of hinted at this a bit at the beginning, but this is the question I haven't been able to answer for the last 5 years, which is how do I find a good financial advisor? Because the advice that we kind of in our community often give is don't go with either of those business models, go with a third business model, which is called advice only, where they don't sell you any products, they don't earn any commissions, they don't even manage your money. Instead, they sit next to you as a partner and give you actual advice. You pay them for their time or for a project. And it's called advice only because they have no incentive other than to make you happy and to be a professional. And this is how like many industries work. Like if you talk to I guess lawyers have different business models too, but some lawyers, they just charge you for the advice. And so advice only, in my opinion, is the absolute best way to go. The next question, of course, is how do you find a good advice-only financial advisor? And my answer has been for the last 5 years, I have no idea. They're hard to find and they're in high demand and yada, yada, yada. And so that's why I started Nectarine. So a year ago, my team and I, we founded a company called Nectarine, and we basically have been curating the best advice-only financial advisors. And then we're putting on into one central marketplace called Nectarine, where you can search based on your state and what you're looking for. You can say if you're a pre-retiree or if you're a tech employee or whatever it is, and then it shows the advisors who match your specialty, and then you just pay. It's $150 for 1 hour. Everyone on the platform only gives advice. You share a screen. The meetings are done over Zoom, so you share a screen. You're on camera if you want to be, and then you ask them your questions. You show them your accounts, and they give you just the advice. And then there's no commissions, no recurring costs, no assets under management, none of the nonsense. It's just financial advice. That's my pitch. Thank you for letting me share it.
Well, share your screen for a second and show us the website, because it's again follows the simplicity principle. And Cody Garrett's a big fan, and he's been on the show. He wanted us to talk about it. And the funny thing is, I walked into a Fidelity strip mall advisor when I was overwhelmed and was trying to take over my finances, but I was about to give them away to somebody and incur all those costs. Luckily, it didn't feel right. It just didn't pass the smell test. And Becky went into Edward Jones. So for late starters, this is a huge problem because you're overwhelmed, you want help, and then you go get the wrong help. And we want people to go to your website to find the right help because people do need help. Show us a little bit about what goes on here.
Thanks. Yeah. So, by the way, if you Google Nectarine today, you will find a lot about the smooth peach, not the financial services. If you Google Nectarine financial or Nectarine advice, you'll find it. But it's actually at hellonectarine.com. One of these days, maybe we'll be able to afford the domain nectarine.com. We can't afford it yet. But yeah, it's at hellonectarine.com. And then, yeah, you just start with your state. And so, for example, let's say we're in Colorado here. You click Find Your Advisor, and that shows all the advisors who are serving Colorado. And so, for example, I can filter and say, okay, I need portfolio review. I'm a pre-retiree. Maybe I need help getting started with investing. The things, the checkboxes that what you need help with, and then kind of your demographic, what the advisors like working with. And then I can see them, and then I can see, and so you can see each of the advisors. So you can see John here works with pre-retirees, offers portfolio review, getting started with investing. And then it also shows their live availability. So his next available, it's January 12th right now. His next available meeting is January 15th at 8:15 a.m. All the availability is baked right into the site. If you go and view his portfolio, you can read all about him, his details, his little personal stuff, and then his education, designations, experience. He's a CFP, which is kind of the gold star letters after name or designation in the industry. And then you book right through the site. You pay Nectarine. Nectarine pays the financial advisors, so there's no worry about disappointing them or recurring fees or anything like that. So you just agree to their terms, schedule appointment, and then when I schedule an appointment here, it's just going to go to their calendar. You book a time, and then, like I said, the meetings happen over Zoom, and you can actually share your screen and show him, hey, here's my investment account, here's my income statement, here's my net worth statement, or whatever you have, and they're great. Unfortunately, this is kind of getting into like our current problem, but a lot of state regulations don't allow financial advisors to show reviews publicly for some reason. They don't, and so you can see some of our advisors, the reviews are hidden, but we can see internally all the reviews, and our average review right now is like 4.9 something stars. People are across all advisors are really happy with their experience. You can see David here has his reviews shown. Yeah, so if you find an advisor that does show the reviews, you get to go read about how great their experiences are. That's Nectarine. It's pretty simple.
Yeah, I mean, that's it. It's that simple, guys. And for late starters, this may be the 1 or 2 hours of critical advice for a relatively low cost, actually extremely low cost, that gets them started. It's a mentor, and it could go to an ongoing relationship where they get coached to a point of independence. And that's money worth spending, I think, right?
Yeah, after your meeting too, we send you an email or your advisor sends you an email with a meeting recap and also kind of like a next steps. So not only you get a review of what you talked about, but also in your meeting, they might say, hey, make sure to go roll over this account or go click these buttons or whatever it is. You get that right in your email. So you kind of have a plan going forward. Yeah. And we've had, I think about 10% of our meetings so far have come back for a second meeting, and then 90% haven't. And that maybe over the years, they'll be more likely to come back. But generally, you just kind of use it when you need it. And like I said, if you're paying 1% of your assets under management over time, which is the better business model, right? The strip mall business model is even worse, but the better business model could add up to be like $1 million in advisory fees when they're not really even giving you advice. They're just managing your money and have no real incentive to give your advice other than insofar as not losing you as a client. Whereas this, maybe it's $150 or $300 or whatever it is. It's a lot less than $1 million, much to my sadness because we're taking a cut of the 150.
Jeremy, I think this is great because even in the FI events that Stephen and I go to, where we're surrounded by other people of like mindset, this question comes up all the time. It's like we tell people all the time, don't do an AUM model if you can help it. Yeah. But then we don't have a place to point them in the right direction. Right. But I mean, all of us need help. So when we first started out, we just needed somebody to look over our shoulder and say, yeah, you're not headed for the ditch. And even when you know what you're doing, sometimes it's nice to have somebody look at it. So yeah, this is awesome. I think this is going to be very helpful for a lot of people.
Yeah, and it's a great second opinion. You can think you know what you're doing, but you want to trust but verify. You got to trust but verify yourself. And it would not be a bad idea. So I think what you're doing is fantastic. We're happy to promote it. And I think this will speak to our late starter audience.
Oh, yeah. I think so too.
Thank you.
We're coming to the end here, but we got a few more questions. And just in all transparency, we love to ask folks what their biggest financial mistake was, because late starters make lots of mistakes. What mistakes or top 2 or 3 did you make?
I have a tough problem with this question. I mean, I'll give a few. I mean, it's like there's no critical, like, I've obviously done very well. I'm doing fine, so I don't have a like this ruined my life type mistake, which I wish. I feel like Dave Ramsey has a story where he's like, I was a millionaire and I became broke, and now I'm like dying on the hill of never borrow a penny from somebody. At least, like, I feel like that's a more like, I don't know, impactful mistake. So but I don't have that one, but I'll just give you a few. Like, one, it was like 2 years ago, I wanted to get more aggressive. I was like, and I had a buddy who was in this oil rig drilling thing, and he came to me with this thing, and he gave me this whole pitch, and it wasn't even his pitch. Like, he found it through someone else, and he's like this hole in Louisiana is like super likely to have natural gas, and you put in $50,000 and they pay you $50,000 every 6 months for 20 years when it pays out or whatever. I was like, oh my God. And I'm not an idiot. I know that there's obviously risk there, but I was like, if it hits, like, that'd be great. So I do it, and then what actually happened was they just kept asking for more money. Like, it wasn't a scam. I don't think they were legitimately fraudulent. They were just, I became like this part owner in this oil thing that I absolutely did not understand. And so I think it was supposed to be like $25,000 was my investment, turned into like $44,000 or something. And then they informed us that they found fresh water 3 miles below Earth, which is maybe one day will be the new gold when we don't have anything to drink anymore. But today it's worthless, not worth drilling. And so we lost all our money. And then they sent me another bill for $2,000 to clean up the rig or something. And, I guess that just, when you asked earlier, like, should you get more aggressive and start investing in oil? I'm like, nope, you shouldn't, because then you're going to lose $44,000 and then have to go start buy a target date index fund. Then I made some other individual investments like that, like picking stocks and stuff that have gone to zero. I borrowed money for a car when I was in my 20s, and now I've taken the stance that I don't borrow money for cars. I think it's just so easy people are so afraid of the big dollar amount for a car. Like, oh my gosh, a car's $30,000. I don't have that. I'll just pay $750 a month for 6 years. I'm like, you're paying all $30,000 and then some. And so if you can just get past that hump of like, all right, maybe buy a much more boss used car in cash for a while and then save that payment rather than giving it to the car company, then you can kind of get over this car payment hump. Yeah, I don't know. Those are some of my mistakes. I get asked that question enough. I should have a better answer.
No, that answer's fine. That's real life.
Yeah, I like the first two because you didn't understand the investment. You made a complex investment and it went to zero. You bought individual stocks that went to zero. Yep. And these are mistakes that we don't want our audience to make. They were perfect.
And I'm no dummy. I knew what I was getting into. There's no success story. I've also made some like angel venture. To be fair, I've done a smart thing, which is with 90% of my money, I buy index funds. The money I'm talking about, despite being big numbers, but now I have enough wealth where 25,000 is, well under 10% for me. So it's still a pretty small number. So I'm doing a very smart thing along with these dumb things, which is I'm keeping most of my money in the smart thing, which has been doubling every 7 years since I've been doing it, as index funds tend to do. But yeah, it's a small amount of my money. And I've made some angel investments too in like small businesses, and those have not yet gone to zero. So either it's going to be a great success I'll talk about one day, or another added to the list of my bad, aggressive picking, right? And when you read about these things like angel investing and oil drilling, they have horrible odds, right? It's like it's a bad investment by all mathematical standards. So I just roll the dice a little bit and have been coming up with snake eyes.
Well, I'll harp on this because I don't use play money. I don't do 5 or 10% of my portfolio in Bitcoin or these brand new fatty ETFs. I am perfectly comfortable keeping it boring. I don't need excitement. And I don't think late starters can afford to mess with 5 or 10% of their portfolio, quite honestly.
I love that. I say less than 10%, and zero is way less than 10%. So I think 100% index funds is a good option too.
Yep. Yep.
All right. So we got a few more questions. Becky, do you want to run them by them before we wrap this up?
Sure. We've got a few questions from the community for you. So, and I apologize if I'm butchering this name. Mira Moby says, Bitcoin ETF in or out?
Out. If
All right.
you want to, a little bit, other like in your 10%, sure, but I don't speculate. I buy things that pay you a dividend and go up in value over time, and those things are index funds and investment real estate. And Bitcoin doesn't meet the bar; it's just speculation. And also, like, I'm a computer guy. I think the clock is ticking on Bitcoin. I think quantum computing is going to reach a point where you can crack Bitcoin keys in a few seconds, and Bitcoin's going to go to zero. It's not going to happen this year, but it might happen in 10 years. It might happen in 20 years. And when that does, it's a game of hot potato. Like who's going to be the last one holding the Bitcoin, right? So I maybe don't get all your quantum computing advice from me, but I say no.
All right.
That's interesting. I have not heard that perspective. You heard it here first on Catching Up to Fi, guys.
That's right. That's right. So question number 2 from the same person, economy soft landing concerns relevant to 2024.
I ignore that stuff. I buy and hold. I'm a sociopathic robot, like rates, Jerome Powell, recession. I mean, I like discussing it. I think in this space, I think it's interesting. And I think, frankly, I think the economy has done pretty well. We thought that we were probably going to see 10% unemployment plus to try to get inflation back down. Now inflation's at 3% and unemployment's still at 3%. Like, how much better could you have hoped for? Am I changing anything with my investment portfolio? Zero. Absolutely not.
Okay.
Buy and hold, sociopathic robot, ignore the news.
Okay. All right. And question number 3 from Mira. Election year impact. Does it matter which party wins? Should we hedge?
Absolutely not. Trying to trade stocks or investments based on political party is probably the best way I can think of to burn money. It's just total nonsense. Anyone who suggests anything is otherwise is either broke or trying to get clicks or something. It's total nonsense. And one of the charts I like, the chart shows like investing only during Republican presidencies, investing only during Democratic presidencies, and investing during both. And then like Republican presidencies, you end up with like 100,000. Democratic presidencies, you end up with like 120,000, and then both is like 6 million or something. It's like, it's dramatic because the cost of being out of the market is so devastating relative to worrying about who the president's going to be. And I have political views, like I haven't talked about them. Like I have strong feelings about who I think would be a good president, who wouldn't. But I am not letting that leak whatsoever. And where I'm putting my money is leaving it right where it is in index funds.
And you know, there's a saying that I want to harp on. People can't hear this too often. It's not timing the market, it's time in the market. So that speaks to your point.
That's what they say, and it's true. It's hard to buy it. I know when you're looking at your own situation, you're like, it's so weird. People all know that. They'll say that line to me, and they'll say, but I should probably wait until the market dips to buy. I'm like, nope, because the market may never be as low as it is for the rest of eternity as it is now.
Right.
A lot of days of the market we'll never see again this low. Today's market price could be the lowest we ever see again. And if it is, and you're waiting to invest, you'll have missed it, right? You'll have missed it. So just invest today and don't worry about it.
Right. All right. So from David Vaughn, we have, how do you avoid lifestyle creep?
These are the hard ones because the questions I like are kind of like the previous ones where it's like, how do I invest or what buttons do I click to invest? The how do I avoid lifestyle creep is like, man, that's like childhood stuff. That's like you were a kid and the people driving BMWs were the successful people, and that is like baked into your psyche. And so I think you really have to look deep inside yourself and ask, like, what do you want in life and what makes you happy? I mean, Millionaire Next Door is one of the books I like on this topic, which is rich people aren't the people spending a lot of money. They're the people who are living modestly and building actual real wealth. And when I reflect on my own life, my happiest times aren't when I've spent the most money. It's when I've been around good people. It's usually when I'm in the most modest accommodations. It's when I'm being healthy and fit. And so there's no easy answer to it. It's kind of like, how do you maintain good relationships? How do you maintain good health? It's hard. You have to remind yourself what's important, and just, I don't know. The way I think about it is like, if you make $150,000, live as someone who makes 100. If you make 100, live as someone who makes 60. And plenty of people who make 40 wish they made 60. And so pay yourself first out of your income, whatever it is. Kick some of that off into the savings, and then just live on the rest.
Mm-hmm. Great. I love that. All right. And then our last question comes from Diana Merriam.
I know her.
I think a lot of us know Diana. And she's going to ask you, why don't you do more public speaking?
Oh. I don't know.
So you can text Diana and say, why did you ask me this question?
Yeah, I don't know. I don't think I'm especially good at it. And it hasn't really been, I've kind of been on the social media horse and the tech startup horse for a while. And public speaking is very emotionally exhausting for me and doesn't scale super well. I guess at the top of your game, if you're speaking a lot to big audiences, it might, but just a matter of time and priority. Diana, but she's the founder of Economy, where I did speak at her conference. And so that's probably why she asked that question.
That's right.
Oh, yeah. She's just having fun like we are. So we've come to the end of our time, and our audience does listen to the end. We certainly hope so. We got to give a few acknowledgments to our team. Becky and I are not alone. We have Diana Falk, who does all of our social media. We have Sarah von Sternberg, Becky's daughter, who does all of our show notes. And please take a look at those, because if you can't remember what's in the show, you can click on it there. And then we also have Fritz Bossard, who is our virtual assistant all the way from the Philippines, who does all of our editing and production. He gives us a bunch of reels for social media. He does a fantastic job. I can only recommend him highly. A couple of calls to action for us today. Write us a review. We need your reviews on Spotify or Apple Podcasts. It helps get this message out to others. Tell a friend, tell 10 friends, tell your enemies, bring them all into the fold. They're welcome in our community. Our Facebook group is now almost 9,000. And I think there's great engagement, great answers. People are really happy with it. Mm-hmm. Then you can also buy us a coffee. Go to the Support Us button on our website. It's the most flattery I think we can get if you think we're doing a great job and you want to donate to help offset some of the costs, which are not insignificant, to running a website and running this show. Finally, we want to hear from you in your voice. Send us a speak pipe, write us an email. We love hearing back from you with your questions, your comments, and it gets us all worked up. So Becky, any final thoughts?
Oh my goodness. I think this has been great. I hope that everybody checks out Nectarine. I hope they check out Personal Finance Club. Jeremy, thank you so much for what you do and what you give to the community. Obviously, you are a person with a giving heart in many, many ways. And so I hope that folks have heard your heart about giving not only money, but your emotional energy and your efforts to others. And the thing that I really hope folks come out of this with is investing can be simple and be profitable. Don't make this more complicated than you need to, especially if you're a late starter. And I made it complicated because I didn't understand it. And then I realized I don't need to just blindly hand my money over to somebody else. I need to understand what's going on. And when I started doing that, I realized how much I actually enjoyed learning about this and how simple it can be and how profitable it can be when you go simple. So thanks a ton, Jeremy.
Your platforms espouse simplicity, which promotes knowledge. It really does. Reach out to them. And where can we find you? How do we reach out to you personally?
Mm-hmm.
Yeah, I'm a pretty easy dude to find on the internet, personalfinanceclub.com, or on the social media sites at Personal Finance Club. There's email buttons and DM buttons, and then Nectarine is at hellonectarine.com, or you can Google Nectarine financial advice or something like that.
All right, that's awesome. Thank you so much for being here today. We look forward to talking to you again about other topics, and maybe we'll do that hour show on your passion where you can rant on investing.
I would love to. I mean, yeah, I had to hold back, and it still took us an hour and a half. So,
well, it's been a very valuable hour and a half. Thanks again. Have a great day, Becky. We'll see you again, and on next week on Catching Up to Fi.
Absolutely. Bye.
We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could leave a 5-star review so that our message can reach others.
We are not lawyers, financial advisors, accountants, or tax experts. Please consult your own professional advisors before making any important decisions. Our content is for entertainment and education purposes only.
We'll see you next time on Catching Up to Fi.